Hi, I'm Grant Stevens.
And I'm Chris Bernier.
And we're the Two Investment Guys. This week, Chris and I want to talk a little bit more about the markets. You know, being the summer period, it's often considered to be a slower time for capital markets. Certainly investors and traders are less active, and companies are also less active in the markets raising capital. But that doesn't seem to be the case this summer. There sure seems to be a lot of activity, a lot of news flow, things going on. You know, May and June were relatively weak with bond yields rising. We saw quite a bit of that put back on, Chris, in the last couple of weeks in early July here. But we wanted to talk a little bit about the kickoff to earnings because we've just started the second quarter earnings reporting season. Chris, so why don't we talk a little bit about that?
Sure, so if we look at the S&P 500, a little over 100 companies have reported. So far, about 72% of the companies are beating earnings expectations, and only about 50% of companies are beating top-line revenue growth. So that's been a real challenge. Guidance going forward has been cautious, I would say, at best. And the bottom line here is the earnings that we're seeing reported, we would say are somewhat low quality because the earnings have been growing on the basis of share buybacks and expense control. So not the type of environment where you're going to see runaway growth.
No, and you know, that's if the market is looking for really robust earnings growth, that's not really the primary sources that we want to see it coming from. You know, it's reflective of a decently healthy economy, but one that's not growing and then relating to true earnings growth on that side. If we turn to bonds, we wanted to talk a little bit about the bond market here because we got a little bit of a glimpse into the future, and that is when we saw 10-year bond rates rise, a lot of the interest-sensitive equities, Chris, took a step back.
Yeah.
And, you know, it was too much too fast, and it's since tapered off a little bit. But it did impact a couple of important things that we watch. One is fund flows. So the amount of capital that was flowing out of bond funds was quite significant, and that was the first time in a very long time we saw that. That could put selling pressure in the bond market all by itself. And I think the expectations for investors around bonds needs to be low here. Not that we're suggesting rates are going to run up, but it did give us a little bit of a look into the future as to what may happen. So now we wanted to turn to, well, what should somebody be doing here, if anything? And firstly, Chris and I have always talked about making sure you have healthy, sustainable yield in the portfolio where many of the things that you own are paying you regularly. You know, and one of the other things is we talk about ignoring all the noise in the market. Don't let that distract you from your plans. You know, diversification, Chris.
Absolutely. You want to maintain a long-term view. And what we saw over the last 3 years consecutive now is the Canadian marketplace has underperformed other markets, particularly the U.S. During the financial crisis, many people retrenched, became overweight Canada. It was a good place to be for a long, long time. But we're suggesting that you need to look at the diversification aspects of your portfolio and take advantage of some of these opportunities. Yeah. So I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to continue our discussion around markets. So until then, I'm Grant.
And I'm Chris.
And we're the Two Investment Guys.